This chart shows a perfect setup. You enter a long gold position, hold for 2 weeks, and the price climbs right to your target. But when you close the trade, the realized profit is hundreds of dollars short of what the math promised. You check your platform. Your account hasn't been hacked, and your broker didn't miscalculate. You're dealing with a systemic mechanic running quietly in the background. When trading gold, you are fighting two distinct forces. You are navigating the price action, and you are fighting the relentless passage of time. Every single night you hold a position past 5 p.m. Eastern Standard Time, a transaction takes place that slowly chips away at your margin. So where exactly do the missing dollars from a mathematically accurate gold trade end up? In the spot Forex market, you aren't taking physical delivery of 100-ounce gold bars to your doorstep. To avoid that delivery, your open position is artificially rolled over to the next value date every night. When you trade AAU USD, you are exchanging one asset for another. Going long requires you to effectively borrow US dollars in order to purchase the gold, and borrowing those dollars carries a cost. With the Federal Reserve enforcing a high interest rate policy, the fee to access American currency becomes highly expensive. This model illustrates the core imbalance. The US dollar has a positive yield, while gold is a non-yielding asset carrying a hidden borrowing fee, the gold lease rate. The daily swap fee is derived from the mathematical difference between these two rates. If you're long gold in a high-rate environment, you are paying a daily premium to push against the monetary policy of the entire U.S. economy. This horizontal timeline maps out a standard trading week. If we track a long position across these 5 days, we can pinpoint the exact moment where the largest drain on your capital occurs. The global Forex market settles trades on a T+2 basis, meaning the trade date plus 2 days. The market must account for weekend interest days, even when closed. That bottleneck hits Wednesday at 5 p.m. Eastern. Hold a trade past that cutoff, and you're instantly charged for Wednesday, Saturday, and Sunday. This triple swap shock explains why calculated trades trigger stop losses on Thursday mornings, even when the actual price of gold hasn't moved a single pip. There is a strategic inverse to this. Traders who short gold are borrowing the metal to lend US dollars, meaning the broker may actually pay them a daily credit, a dynamic known as positive carry. Institutional strategists carefully time their exits to avoid that Wednesday night drain, separating their approach from retail traders who leave their capital fully exposed to the settlement calendar. This creates the real yield trap. If the price of gold moves sideways for an extended period, mounting carry costs ensure you are actively losing money. This equation calculates your carry-adjusted break-even, swap rate per night, multiplied by days held, divided by pip value. In practice, the longer the trade remains open, the higher the true break-even line creeps above your entry price. You also have to watch for retail markups. Many brokers artificially inflate their rates well above the interbank baseline, quietly siphoning off additional fractions of your edge. Before you place your next gold trade, use the FXNX swap calculator and transparency dashboard to audit your broker's carry costs and run the math yourself. Mastering these hidden fees elevates your trading. You stop simply reacting to chart patterns, and you start controlling the financial mechanics of time.